All right, today we are diving into a pretty unique geometric approach to the markets. We're going to be documenting a specific market DNA cycle for silver, also known as XAG. So what you're looking at here is a price chart for silver. But as you can see, it's got this really distinct geometric structure laid on top of it. This comes from the market DNA method. Our goal is pretty straightforward. We're just going to walk through the documented phases of this one specific cycle using only the source material provided. So let's jump right in with the first step, the entry. Okay, phase 1. This is where the whole cycle gets started. This phase is all about defining the entry points for a potential trade. And in this case, there are two key levels we need to look at. First up, you've got the primary entry point. It's labeled M, right there on the chart, and it's defined at a price of $46.32. Then there's a secondary optional entry point. This one is labeled PC, and it sits at $43.52. Now, this isn't just some backup plan. It's actually a built-in part of the cycle's risk management strategy. And, we'll see how that plays out in the potential returns in just a moment. So, we've got our entry points defined. The next logical question is, well, how is the risk actually managed? And how is the trade sized? That's exactly what this part of phase 1 is all about. So the model's calculations kick off with a hypothetical capital of $100,000. A really key constraint here is the maximum drawdown, which is capped at 5%, or $5,000. That, along with the other parameters you see, like the 38-day time duration and the risk coefficient, they all work together to figure out the actual trade size. So how do all those numbers lead to a trade size? Well, this table breaks it down. Using the mean entry price and the expected low, a position size gets calculated. The bottom line here is that this results in an each trade size of 0.03 for each of those two potential entries. Both trade sizes are calculated using the hypothetical capital, the investor's maximum allowed drawdown, the third triangle domain percentage, the risk coefficient, and the contract size. Okay, with the entry and risk now defined, phase 1 also goes ahead and lays out the projected targets. For this cycle, there are 3 potential price targets on the map. So the model gives us 3 distinct targets. Target 1, or T1, is at the mirror line priced at $47.63. T2 is located at what's called Apex N, and it's designated as a safe exit point at $50.70. And finally, the ultimate goal, T3, represents a full exit at the very top of the trapezoid priced at $53.70. Now, this is where it gets really interesting, seeing how those targets translate into potential returns. So in scenario 1, if only that first entry at M is triggered and the cycle goes all the way to target 3, the expected total profit is $2,214. That projects out to an expected annual return of 21.22%. But what about that second scenario? What if the price does drop enough to trigger that optional PFC entry we talked about? Well, the whole picture changes. The expected total profit almost doubles to $4,368, and that shoots the potential annual return all the way up to 41.97%. That's a huge difference. So we have our entry points, we have our potential targets. Now let's take a look at the documented roadmap, how this cycle is actually expected to play out from start to finish. The journey follows a pretty defined 4-phase sequence. It all starts with phase 1, the entry, which we've just covered. From there, the model anticipates phase 2, something called a mirror contact. After that comes phase 3, an N-level event, before it finally hits the last step, phase 4, which signals that the cycle is complete. So what exactly is phase 2? It's defined by a very specific visual event. As you can see highlighted right here on the chart, it's the exact moment the price action makes contact with this diagonal line, which the model calls the mirror delay line. And moving right along, we get to the next step. Phase 3 is documented to happen when the price manages to reach Apex N. This point, as you can see, is the very peak of that third triangle structure on the chart. And that brings us to the finish line, phase 4, the conclusion of the cycle. This phase is officially hit when the price touches the top boundary of that big blue shape, the trapezoid. Once that happens, this whole documented journey is considered complete. Now, before we wrap this up, it is absolutely essential that we go over some important disclaimers about this documentation. So please pay close attention to these next points. This is not financial advice. Analyses are for documentation and public verification only. Leverage above 10 is prohibited. Do not invest essential personal funds. Risk management must follow the provided instructions. So taking this detailed walkthrough a single silver cycle really gives us a window into one very specific geometric method. And it kind of leaves us with a bigger question to think about. How do defined geometric systems approach market visualization?